Hello, chaps and ladies. Greg Silverman here, Chief Investment Officer. Another session of Come Learn with Me. We look at the articles that everyone likes, shares during the week that we publish, and we curate them a little bit, and then we see what percolates to the top. This is one that percolated to the top. Not a surprise. I mean, this bull market in tech, is it ever going to end? You've got to wonder. Maybe with higher interest rates, right? You guys been watching interest rates? That 10-year note's been climbing. I do watch it. All right, let's get to it. Tech startup financing hits record as giant funds participate in 42% of funding deals. Okay. Mutual funds, hedge funds, and sovereign wealth groups and pension funds are overtaking the tech startup investing landscape, leading to higher valuations and more leverage for business founders in 2021. Large money management companies took over Silicon Valley in the second quarter, dwarfing venture capitalists in a once niche business and putting 21 on the right path to potentially double 2020's record in startup financing. I would like to remind you all of a previous video we did that this time is not different. Take a look at that one. Non-traditional venture investors were more active in Q2 of 21 than ever before, participating in 42% of startup financing deals. Furthermore, those deals constituted more than 3/4 of the total capital invested. Startup funding in the United States reached the $150 billion mark in the first half of 21, eclipsing the full year of total investment of every year before 2020. So if you're wondering what you should be doing, not my advice, but it looks like you should be doing a startup. Not my advice, okay, guys? Just to be clear. There are a few aspects that make large asset firms more appealing to startup founders and could explain the dizzying deal-making pace we are now witnessing. Big money management companies have huge capital pools, move quickly, and aren't likely to request board seats or ask to get involved in the company's decision-making process in any other way. It is true that big money managers have been allocating a small percentage of their portfolios to invest in companies that typically draw the attention of traditional venture capital funding providers for a long time. However, many began investing directly about 10 years ago in a near zero interest rate economy, hoping to make the most of excellent returns from tech companies that were remaining private longer. Throughout the last decade, traditional venture capitalists considered them tourist investors who lacked a certain skill needed for startup investing. That may be true, it may still be true, so it might be fast and not so smart money. Nevertheless, large asset firms stuck around. Nowadays, non-traditional VC investors such as Tiger Global Management, which was a hedge fund, and Fidelity Investments, Inc., which we all know, are among the top 10 US investors in startups by dollar amount. Additionally, according to the information provided by research firm PitchBook, the number of startup funding rounds that include zero venture capital firms and other non-traditional venture capital investors has doubled throughout the last decade. It's interesting to mention that despite these changes, many startups still need to turn to alternative funding resources such as crowdfunding, particularly if they are just starting out. Okay, tech is at dizzying heights, no doubt. All right, guys, thanks for joining for that one. Greg Silverman, your COO, another session of Come Learn with Me. Beautiful background behind me. Out for now.